Hello, everyone. Welcome to the Nest Egg Builder Show. Today we have Bruce Mack. He is going to talk about something that we call the Spendthrift Trust, but it's a trust that helps you but helps you lower your taxes and shield your assets. He is a speaker. He's a real estate investor and protector of $90 million in transactions, and he's a financial advisor, which is really important when you want to know how to grow your wealth. You need somebody who can look at what you have and advise you. So thank you, Bruce, very much for being here today, and please take it away.
Well, thank you so much. Let's see. I'm going to try and do the screen sharing. Can you? Oh, great. Thank you.
You're welcome.
Here we go.
That was my magic fingers called Cliff.
Can you see my screen? Yes?
Yes, we can see your screen.
Fantastic.
And we can see your slides on the left.
Great. Now I need to go full screen with them. So just give me 1 second. Why? This is unusual.
Well,
I see what's going on. We should be good to go here.
There we go.
So you can see everything and my screen's fine?
Yes, it's a full screen.
Fantastic. Well, first of all, thank you so much, Peggy, for the opportunity to speak to your group of investors. I'm looking forward to it, and I have a ton of information to give. Yes. So without further ado, I'm going to jump into it.
Okay.
I'm a trust advisor. I'm a licensed financial advisor. I'm a real estate investor, business consultant, speaker, as well as author. So platinum trusts are a must for real estate investors, and there's several reasons why this comes to be. Our proprietary trusts offer asset protection, first and foremost, and most importantly, tax mitigation strategies that we'll talk about, and generational wealth transference as well, along with complete privacy, something that other, if you will, types of strategies just don't offer, and we'll show you exactly what we're talking about. So many of you are familiar with trusts, but the trust that you are familiar with, and you may have one, in which case that's great because we can incorporate your existing trust into our trust. But many of you are familiar with trusts, and the trust that you're familiar with is a living trust, or what's called a living will. They're created during your life. They are for probate avoidance. They are for naming the beneficiaries, and they are very limited because, unfortunately, based upon the type of trust that they are, which is a grantor revocable trust, they do not and cannot offer asset protection and or tax mitigation. I took the liberty, we created a chart. It really kind of lines it out for those A-brainers of how our trust is different from other modalities that you can hold properties in and or structures. So let's just kind of go all the way down the list for a moment. Let's talk about capital gains. Capital gains with a C or an S or an holding company, and or some of you may be utilizing land trust strategies or living trusts or wills, do not have the ability to exclude capital gains and or eliminate them. And with the Platinum Trust, yes, we do have that capability. Deferring on income tax. Again, that is something that we can do. These other modalities do not have the ability to give you that type of capability. The avoidance of lawsuits. And we'll talk about what they can't find, they can't sue, let alone the fact that the track record of going against our type of trust is horribly stacked in the non-favor, if you will, of litigating attorneys. More on that as well. Avoidance of judgments, liens, and levies reaching the business, just not able to happen with our type of trust. The avoidance of probate, yes, that can happen. Gift tax, estate tax, beneficiaries, assets being transferred, multi-generational wealth accumulation, absolutely, because that's what we're doing it for, right? Is for our beneficiaries, and the avoidance of annual fees. So we do talk and will talk on in this first section about ironclad asset protection for your business assets. Asset protection is absolutely a must. And just when you think that everything you have worked so hard for is going great, I've seen it time and time again. I perennially, usually once a week, get a phone call from, I'd really like to know about your trust. And if there's anything that you can do, I just got served, and or I'm in the middle of a lawsuit, and or this more of the same. And the fact is, it's a common thread. I hear it all the time, and you can lose it all unless you're properly protected. Statistically, property owners are liable for all injuries incurred due to hazards associated with their property, whether it's a home or a business, and or rent, including, of course, rental properties that you may own. Slip and falls annually are the #1 most common personal injury lawsuit. Since 1980, personal injury lawsuits have increased by 30%, which is staggering. About 25,000 people a day are, quote, victims to slip and fall. So it is a tragedy and or a malady that is constantly occurring. Asbestos and lead paint-based lawsuits. Asbestos exposure is the main cause of mesothelioma. Boy, that's a mouthful. And we've seen awards in excess of $30 million. According to Measley's litigation report, the average mesothelioma, sorry about that, trial award is $2.4 million. Again, staggering numbers. Landlords are also being sued for lead-based paint illnesses, and a very common one that I know that you have heard about is mold issues, toxic mold, black mold. And in this case, Kellen Gorman received a $13 million settlement from a toxic mold lawsuit, and needs 27 or 24/7 care for the rest of his life. Statistically, according to IFG studies, Americans have a 1 in 3 shot of getting sued. And if you're a surgeon, a 2 in 3 shot. Now, from the studies that we've done as real estate investors and being in the industry for decades, I can tell you over 50% of the real estate investors that we come in contact with have been sued or will be sued at some point in time. It's just a fact. As a real estate investor, you do have a target painted on your back. It's an unfortunate reality that goes with the upside opportunities to make really great income. There are 153,846 lawsuits filed each and every day in the U.S. Staggering number. The average business lawsuit is now up to 77,500. By the way, I did a slide refresh on this, and the number was tens and tens of thousands of dollars less a couple of years ago. And the average litigation cost was in the early 70s instead of the later 70s. But again, things progress. We have inflation, and we just plain and simple have a lot more lawsuits. Currently, the U.S. has over 91,000 PI lawyers. Most of them work on contingency. Their fees are between 20 and 40% of the entire awarded amount. So you know they need to put bread on their table. They're looking for these types of lawsuits to be able to enrich themselves. And something that people are not aware of is that insurance will not cover what's called punitive damages. You may have heard about these before. These are settlement awards that are above and beyond what policy limits call for, including umbrella policies. I have never seen an umbrella policy that covers for punitive damages. And when they are awarded, oftentimes they are the much higher amount of the award than the actual base amount. For instance, here at Dog Point, $6.9 million, hot coffee spill. Actually, let me stop about the hot coffee spill. Many of you heard about the McDonald's Hot Coffee Award for $3 million. But what you didn't hear is that $2.7 million of the $3 million award was in punitive damages, none of which would be covered or in a lawsuit under the umbrella protection that somebody might have for $1 million or more dollars. So a sad but true fact. Car accident, we've seen as much as 30, 40 plus $1 million. Lawsuits can tap into your business and personal assets, and they can also, when strategically done, pierce the corporate veil, whether it's a C, an S, or an LLC. Closely held LLCs or corps do not protect you. The owner has created a facade for controlling the entity. It's called alter ego. This is it's really a third-year law student, if you will, claim when you have a closely held entity. Most real estate investors use LLCs, and LLCs fall prey to this because by definition, real estate investors are.
What's the plan?
I'm sorry?
No plan right now.
Oh, I'm sorry. LLCs.
Can eat if you want. Hungry.
If somebody's speaking in the background, if you would, it's a female voice, and if you would, please mute yourself out. I'd appreciate it. Thank you so much. So LLCs, by the very nature of what they are as real estate investor LLCs, are closely held entities. Matter of fact, doing some research, it shows that the definition between closely held and widely held, the breakpoint is right around 35 people. Well, I've never seen an LLC that has that many people in it. It's usually a single member or a partnership. So it's one or two people, maybe a couple of more, but they're always closely held entities. And as such, they fall prey to this third-year law student claim, the claim that you have created a facade because you are controlling you, which is the shareholder, and therefore it's called alter ego. And therefore, the LLC can easily be blown up or pierced. Corporate formalities is another way that LLCs, Cs, or S's are pierced because of record keeping and record retention may not be as complete and or up to date as it needs to be. And if those are looked at, again, that could be highly problematic. Small business owners mistakenly write checks. We see this one all the time from the company account for personal payments. So there's not one thing, but a number of things that could ultimately lead to piercing the corporate veil. Now, we did a study of the study, and the study that we looked at was from Wake Forest Law Review, and that study showed that when courts pierce the veil in 46% of the cases when litigated. So what the finding is that almost a 1 in 2 shot, if you get litigated against, and they use that alter ego, if nothing else, in a closely held entity, you stand almost a 1 in 2 shot of your entity being pierced. Once the entity is pierced, of course, they can go in and they can take any and all amounts of the contents to get a satisfaction of judgment. Now, something that most people have not heard of is what's called reverse veil piercing. Now, not all states recognize it, but I can tell you that California absolutely does recognize reverse veil piercing, and that might actually be worse Now, some of you don't have any LLCs, Cs, or S's, and you hold your property personally. Okay. Some of you own LLCs and have grouped properties and or assets together to put into into a single LLC. And the reason you probably didn't want to have multiple LLCs is because the $800 plus charges from the franchise tax boards and the need to also file expensive tax returns for each and every entity. Okay. Or you may have separate LLCs for each of your properties that you hold. And again, that's another strategy. And the constant thing that I hear from people is that I did that. I was willing to pay the extra dollars because what it means is that in the event that I get sued in LLC number one, and I have a $1 million award against me, but I have a $250,000 asset in the LLC, my only exposure is the $250,000. Well, unfortunately, that's just not correct, because a lawsuit against you personally can allow the plaintiff to recover damages by reverse veil piercing the corporate veil, allowing them to reach the assets in your business entity as well as your personal assets. Closely held entities are at high risk. So what the courts are saying here is they can go into the next LLC, the next LLC, the next LLC. If you've got 10 properties and it takes 10 properties to get a satisfaction of judgment, they have the ability to do that by implementing a reverse veil piercing strategy. I love this slide. Shield your and protect your businesses and your family against lawsuits, judgments, levies, liens, claims, and or divorce. Ironclad protection for your personal assets. Let's take a little deeper dive. So in this particular case, a personal friend of mine in LA, when I used to live there many years ago, got into a very bad traffic accident. He was found to be at fault. He had not been drinking. He was found, though, to be negligent. And negligent is definitely gives the courts to then get into the punitive damage, if you will, world. And in this particular case, above and beyond the umbrella that he had, which was $1 million plus umbrella, he ended up having to shell out of his back pocket $250,000. This could happen to any one of us unless you have the right type of protection. And of course, the trust is the right type of protection. In this particular example, Matt's son got into a very bad car accident. Unfortunately for Matt, or actually in the end, it worked out for Matt. His son was 17. Therefore, as a minor, Matt had the responsibility because of the minor son. And in this particular case, Matt was in the process of getting sued. Matt was getting harassing phone calls almost daily from the potential litigating attorney talking about suing for him for over $1 million. And Matt finally said, enough is enough. And he got the attorney on the phone and told him about the fact that he had the trust. And what do you know? He never heard from Matt again. Actually, the plaintiff's attorney ended up doing a settlement with Matt's insurance company, but this did not transcend to Matt personally, and it was over. And I think the other lesson learned from this was that Matt did not have to go in for depositions. Matt did not have to go into court. It was taken care of behind the scenes, because the guy knew that he was not going to be getting some huge award above and beyond policy limit.
And we are at 20 minutes now. How much further do you have to present?
About 10 minutes or so. So thank you very much for that heads up. Appreciate it.
Yeah. Can you cut that down a bit?
Yes, I sure can.
Okay.
you.
I'll try and zip through the rest of this so that we have we'll get there right around the 30-minute mark. Property and assets held by a properly constructed trust cannot be seized. There's case law on this. I lost. We can certainly talk about it in the Q&A. $175,000 from a bad house deal, and if I had known about the trust, couldn't have happened to me. Our trust is not subject to tax liens or levies issued against beneficiaries, trustees, divorce, alimony, child support creditors, governmental agencies, or third-party claims. The only time the trust can have a motion to set it aside is if there is what's called fraudulent conveyance, meaning, or an example of which is being in an active lawsuit and then deciding you want one of these types of trust and trying to move your trust fraudulently into the trust to avoid collection activities. A trust is not a person, and therefore it cannot be sued. And our specialized trust, therefore, like I say, cannot be sued. It's not recognized as a person. One of the key provisions in our trust is a spendthrift provision, which talks about the fact that the corpus may be penetrated to reach the assets in the corpus. If you do not have this provision, ours does. We've never had this happen. And again, over years and years and years, this is how this type of trust operates. Medicare and the trust, income received into the trust is excluded from qualification calculations and or as exempt from the asset recovery program. We'll talk now about tax mitigation. If you're planning to sell your property or properties in business or home or any other assets, you have the ability to exclude 99 to 100% of the capital gains taxes using IRA compliant trusts. This is done because the trust, you will convey and sell your property, personal property and or real property to the trust or properties to the trust. And then the trust makes the sale. Therefore, the money that comes in is a what's called return to corpus. And as long as that money stays in the trust, it cannot be taxed. And the trust does have a automatic distribution provision, which is upon the death of the last sole surviving heir to the last sole surviving beneficiary, likely because of the waterfall effect. This is hundreds and hundreds of years from now, becomes inconsequential because anyone and everyone who's associated with the trust has passed away at the time that the trust is distributed. So this is a wonderful opportunity for all of us with the trust relative to capital gains and also relative to rent and lease income, which currently you have a 27.5-year depreciation table on, but that does not give you near the type of tax mitigation that the trust can. Ordinary income or loss generated sale of IRS statutes. If you become a dealer, this could be very ugly. This is for people who are primarily flippers. If there are any flippers that are on today, let's talk about this. This can be a very, like I said, a very ugly scenario where you give up roughly 50% or more of your payday if you get cast as a dealer. And flippers are ones that are in the gun sights for being cast as dealers. There's no need for 1031s. A lot of people think 1031s are great, but they're not so great when you go to cash out that next property because you get hit with what we call a tax bomb because of the deferral from the previous property. And therefore, you've got an accrued tax problem with both properties hitting you all at once. We are what I would call the anti-1031 company. We have the ability to mitigate your annual tax bill by deferring taxes legally per IRS trust codes. Trust defers and minimize income and estate taxes to the fullest extent the IRS allows. Zero gray area, zero capital gains until distributed. And our trust actually simplifies the accounting process. 60 of the nation's largest companies, including Amazon, Netflix, and IBM, paid zero in taxes on the pre-tax income. Matter of fact, there was just something in the news about them trying to break up Amazon to be able to potentially get them bigger tax bills. I just saw this last night I was reading. But the fact is, we all know that if you have good tax strategies and tax advice, you're able to mitigate taxes to whatever extent the capabilities are of that legal team. Legal case rulings here in the Edison, California stores, also in the Weeks versus Sibley case, they ruled that our type of trust is not illegal, even if formed for the express purpose of reducing or deferring taxes. We believe in full transparency when it comes to business income tax, when it comes to trust income tax, when it comes to personal income tax. And with the professionals we work with, having prepared countless returns, there's only been one audit. That was a year ago, August. I'd be glad to discuss that particular occurrence. But the good news is they were audited for 2017, which was before they even got the trust in 2019. And yes, they were eventually, or also I should say, audited for 2018 and 19, and the results came back no change. And that person has over 70 single family residences as income property. So she has a very, very robust business. Amazon paid zero in taxes on $11 billion in profits. They even received a refund. And again, I attribute that to great tax strategies and advice. These are few of the many people that are millionaires that all have the same thing in common. Yes, they all have trusts. Yes, they all have dynasties, trusts. Yes, our trust does have a dynasty provision baked into the trust. And actually, this article shows how the billion-dollar Kennedy family fortune, this was a reprint from a 2014 article in Forbes, was able to defer and or eliminate tax. Here we talk about the Forbes family and how they were able to maintain, or the Forbes magazine, I should say, talks about the Rockefeller family and how they are able to maintain a substantial amount of their fortune because of the use of trusts. Even here, I happen to see this on TV not that long ago. Camilla Harris keeps her assets in a tax advantage trust. Now, all of these, as you can see here, are trust, if you will, activities, meaning that the trust can pay for these expenses. And I'll take one for a quick example. That's your primary residence. Today, you have one write-off. That write-off is your interest portion of your mortgage payment, if you have a mortgage. But with a trust, the entire mortgage payment, the entire property tax payment, the entire utilities, including your internet bill, your homeowner's insurance, a domestic if they come in and clean, your pool person, your gardener, and any repairs or replacement of furnishings are all trust, if you will, activities and trust expenses that are completely legitimate. We can also talk about school. Many of you may have kids or grandkids that you're wanting to help out, and those are also viable trust expenses for preschool, elementary school, high school, undergraduate, graduate, and even postgraduate studies. The difference between a taxable distribution and a trust expense is perfectly articulated here. If you give the tuition to your kid or your grandkid and told them to put it in their bank account and then go and pay the college of their choice, then they would also need to be receiving a K-1. However, if you're paying on behalf of the beneficiary directly to the institution, and in this case to the college, the $10,000, the $20,000, the $50,000, now you've got a viable tax, if you will, trust expense. How do I get money out of the trust? Conveying your assets to the trust. Use your trust to pay for your business and personal expenses. Now you can enjoy assets such as cars, properties, yachts, and more. Pay expenses for beneficiaries, as I just said, such as education, certainly all medical, maintenance, as well as support. The actual investment in the trust is a trust expense. The present administration, we all know that there's an increase in taxes. They've created an inflation, which is a hidden tax on everything. You may not know this, but this is coming right around the corner. In the next 3 years, the estate tax cap will go from 12.9 million to actually 5 million. They're saying adjusted for cost of living, it will be 6 million, but from 12.9 to 6 million, many people will be over the estate tax cap, in which case they're going to be, if they pass away when this happens, their estate's going to be hit for 45, 55% estate tax. Not so if you have our trust, because our trust inures. You will name successor trustees, and with that waterfall effect, will inure multi-generationally. So for assets in a trust, there are zero capital gains, whether it's stocks or bonds, and many of you have stock, bond, and or crypto trading accounts, currency trading, Bitcoin, selling assets to another trust, real estate acquisitions, buying and selling of businesses. We work a lot with people who have other businesses other than real estate, and they're in a sell mode, in which case they're looking at a potential huge capital gain, which again, we can talk about helping mitigate. No federal or state probate, no gift tax, zero capital gains on the growth or sale of trust-owned assets. The sale of assets to the trust, when you make those sales, are non-taxable events, a question that usually comes up. And unlimited amounts can be sold to the trust, so there's no cap on the amount of possessions and assets that can be sold to the trust. This is the cover of Apartment Management Magazine. A couple of years ago, I wrote an article. We discussed Prop 19, the impact of Prop 19. Let me quickly say that we have a solution with the trust where you will not have to worry about, if you're titled currently in your name, your beneficiaries getting killed and potentially getting assessed with that 1.25% for every $1 million in profit, which, heck, if you have a $10 million portfolio, your heirs could be incurring a $125,000 tax bill annually. And again, we have a solution that circumnavigates the Prop 19 pitfalls. And as long as the beneficial interest does not change, which of course would be the case with the trust, there cannot be a reassessment. You sell your properties to the trust in a strategic way so that there is no change in the beneficial interest, and again, therefore no reassessment. Children, grandchildren become trust beneficiaries, therefore they benefit from the properties after death and also get great asset protection. I have another article coming out. We talk about trusts, we talk about LLCs, we talk about a lot of the things, the 1031 exchanges, that will be out, I believe, next month. Generational wealth transference, very quickly. Platinum trusts have been an effective vehicle for passing on wealth to future generations. Our trust minimizes estate taxes due to the waterfall effect, passing from one generation to another. Platinum's dynasty multi-generational trusts also are useful in sheltering assets and divorce settlements and from creditors, and can easily last hundreds of years. Maximum privacy. The short and long of it is, the way our trust is constructed, you are not filing our trust and putting it on public record anywhere. This is a personal and private trust. Also, in the construct of how we work with you, if we create a business trust, we would have separate divisions. And no, we would be eliminating LLCs, and therefore we are eliminating the ability to do easy asset searches, find out if you are a target, and therefore once that is established, go after that target. Again, this is a recap of that original or first slide that we saw. And we have multiple strategy, whether it's for personal / family trusts, business trusts, private family foundations, and with our experience and expertise, we can design the right strategy for you. And what we're doing for all of you that are on the phone today, that are part of Peggy's group, we're offering a complimentary consultation at zero charge. Normally it's $250. We're waiving it. And this is how you can get that complimentary consultation. You might want to grab a camera, your iPhone, your Droid, what have you, take a picture of this slide. You can either email me at this number at bruce.platinumtrustgroup.com. That will automatically, when you put that URL in, that will take you to my interactive calendar where you can take and choose a time that works best for you. I'll give you a call personally and we'll jump right into it and see if the trust makes sense and or what type of trust makes sense in the construct and the structure of that scenario. If you can't get to my calendar for some reason, you're having trouble, what have you, that's my direct phone number. Certainly you can feel free to give me a call as well. I make myself available for you. That's it. I wanted to speed through this, Peggy. I'm opening it back up to you.
Okay, thank you.
Absolutely.
What a nice presentation. Thank you. Thank you for the explaining. And I can see it does take a little longer to explain this because it is a little different than what people are used to and what they do already know. So I have a question, which, I start out with our questions. So you brought up Proposition 19, and in California, we have Proposition 13.
Yeah.
And in Michigan, they have a proposition, it's got a different name. That's pretty much like Proposition 13. So what is the difference between Prop 19 and Prop 13, please?
Prop 19 replaced Prop 13. And in the old Prop 13, if there was a change of beneficial interest with the seller, i.e. to their kids, or what have you, in their beneficial line, there was not a reassessment that was done or that is being done by the county clerk. Now, with Prop 19, the blood, and I'm distilling down to the blood and guts of what people are concerned with. With Prop 19 now, if mom and dad have the property in their name and mom and dad pass away, and then the beneficiaries would be the kids, they are not originally on title in the first place. And they had to have been on title prior to February a couple of years ago. So we can't go back and retroactively change things. But the point is, if they weren't on title as of that time, anything that is sold or it becomes a part of a estate and then distributes, the county clerk will go in and reassess the property to present day value. Now, what that means is, and this depends upon what the county assessment is. Most counties in California, the property tax assessment is 1.25%. So therefore, on $1 million of reassessment, you're looking at $12,500 that the heirs of the estate will have to incur on an annual basis to keep that property. Or if you prorate that out, that's what, $125,000 over a 10-year period of time. Now, if somebody chooses to get our trust, we have a strategic way of being able to keep the beneficial interest intact so that the heirs will not get clocked or get hit with that assessment. Now, for real estate investors who have multiple properties, this actually can really balloon up and be a really big problem, because if you have, say, 10 properties or 20 or 30 properties and you have $10 million, which is what I was showing in that example, in your estate, now you're looking at $125,000 a year that the heirs are going to incur unless they can do something about it. We've
Oh,
got
well,
the,
it's much worse than that because their basis now is whatever their parents' basis was. And if they wanted to sell it, they're going to have capital gains based on what the parents paid, rather than inheriting it and getting the step up.
there are a host of issues. I'll put it
Yes,
that
there
way.
are.
And we can definitely talk about those solutions on a call, and I'd love to. That's one of the things we love to jump into.
Anyone else have a question or comment or thought regarding this at all? Wow, I'm surprised.
This is a quiet group.
This
Either
is
I did a
unusual.
fantastic job or I did a horrible job.
Jamila, you just came in?
Hi, Peggy, it's Steve. I have a question.
Yes, please, Steve.
Oh, thank you. And thank you, Bruce, for a great presentation.
Well, thank you, Steve.
My question is directed more toward, there seems to be so many benefits from the trust that you're providing. Why isn't this more known? Is there a cost that's prohibitive? Is it something that is risky? Tell me a little bit more about the reasons why it's not as popular.
Well, actually, asset protection and tax mitigation trusts have been around for decades and decades. And as we all know, and some of this is my own personal perception, and some of this, and I'll get into that in a moment. I'm sure you would agree that 95% of all Americans, or something in that very close to percentage, are W-2 employees. I'm sure we would all agree that that's the case. W-2 employees cannot, if you will, benefit from a tax mitigation standpoint with the trust. Or let me put it another way, W-2 employees from their W-2 employee salary cannot get offset, mitigation, deferral, so on and so forth. Now, if they're W-2 employees that have real estate portfolios, then of course we do have the ability to help out on their lease and rental income, capital gains, etc. So I think, therefore, this is something that is only, from a tax mitigation standpoint, is really viable only to entrepreneurs. And therefore, that's a much more finite group of people. It's a much smaller group of people. Also, on the other hand, I don't think you're going to be hearing in open discussions, people like not to talk about money. People like not to talk about these types of things, and they are not in what I would call a sharing mentality. So my perception is that there are a lot more people that have these types of trusts than you and I would ever know about. I was absolutely floored myself when I happened to catch, I was doing some channel surfing and I saw the Fox News. I caught that slide that you saw about Kamala Harris has a tax advantage trust. So many people have trusts that are tax advantaged that we don't know about. And the other part of your question is, are they cost prohibitive? They're not right for everybody. I would never say that they are. And in certain situations, I've told people, look, you're really not a good candidate for the trust. And if that's the case, I'm the first one to say that you're not the right candidate for the trust for whatever the reason, or perhaps multitude of reasons are. But hopefully that helps answer the question.
Well, yeah, thank you, Bruce. I appreciate that. If I could, a follow-up, what are some of the maybe disadvantages to the trust? It seems to be so far superior to other entities that you can hold assets in. Are there any disadvantages that you see?
Have you ever been to London?
I have.
Did you rent a car?
It was so long ago, I don't remember, but next week I'm going to go.
Well, report back to me.
Okay.
I think a disadvantage is like putting on a new pair of shoes. A new pair of shoes can be a little uncomfortable when you first put them on. Renting a car and driving in London can be a little uncomfortable when you first get in the car because of the muscle memory that we all have of doing things a certain way and being accustomed to doing things in a certain way. Now, what we have done is we try and take out as much of that adjustment as possible. Should you decide to move forward with us, we have group calls with existing people, 70-80% of which are existing real estate investors, either part or full-time. We also have trusted advisors that get assigned to each person. So what we try and do is we try and make things as comfortable and easy as possible. There are going to be adjustments, but I will tell you, if you do rent a car, mark my words, and I want to hear from you, Steve, that if you rent a car in London, you're going to have that adjustment. It's going to be an adjustment, but I'll guarantee you when you come back and you jump in your car, you'll have another adjustment to make because you'll be more attuned to driving on the other side of the road. So getting used to the trust structure and operation is a little bit of an adjustment. We help you through that process, hold your hand. But once that has been that period, if you will, that 4 to 6 week period, which is the general implementation time frame, you really know what's going on. You understand what the rules of the road are, and things become very, very simple and actually, in many cases, a lot easier.
Great. Thank you, Bruce, for your answer. Appreciate you. Thanks. Bye-bye.
Anything else, Steve?
No, it sounds great. Thank you. I will follow up. My good friend Cliff also told me about an irrevocable complex discretionary non-grantor spin-through. I'm like, whoa, this is complex stuff. I need advice. I need help. Thank you, Peggy. Great.
Yes.
We're here for you, Steve.
A lot of things are complex in our lifetime. Jamila, you have a question and you came in very late. So
Yeah, sorry about that. Yeah, does this, so the capital gains, when you have a syndication that's closing, if it's in a trust like this, you don't have to pay it?
I'm sorry, what was the question?
The capital gains when a syndication closes, like every 5 years, usually it comes
Sure.
to.
Yeah, whether you're an LP in a syndication, you're getting quarterly distributions, maybe, and then you're going to get a lump sum, which is the big payday at the end of the rainbow, 2 years, 3 years, 5 years out. And your question is, do you have to not pay it? The capital?
No. Yeah, that's right.
I would never, ever, never say you don't have to pay the capital gains. That would be tax evasion. What I would say is that the capital gains become excluded, and because you're going to move that asset, even though you're in that asset, that's a perfect if you will example to be able to assign that asset, to be able to convey and sell that asset to the trust, so that all of your quarterly distributions are coming into the trust. And therefore, as long as you are utilizing the proceeds of those quarterly distributions and or the capital gains for trust, if you will, expenses, which is anything and everything in your personal life and your business life, such as your medical, such as your home, such as future investments, such as cars, boats, planes, trains, RVs. Matter of fact, there's only 3 things that would result in a taxable distribution. They are, you ready?
Mm-hmm.
What we call personal fund, personal food, or personal fashion. Now, notice I didn't say business fund, business food, or business fashion. So if it is business, then of course, just like with your business now, it is a write-off or it is a viable trust expense. Now, there are exceptions to that rule. For instance, do you have children?
Yep.
Are they under 21?
No, I do not.
Oh, you do not. Well, let's just say you did. If you have children and they're under the age of 21, 100% of their food and 100% of their clothing, i.e. fashion, is a trust expense.
Hmm.
Also, if you took those kids on educational outings, let's say you live in LA and you want to go to New York, great. Take them to the Empire State Building, Statue of Liberty, or some sort of educational venue. And of course, now that becomes an educational expense for your guys' flights and for your stay. So there's many exceptions to that food, fun, and fashion. Another exception is what we call the demand note, which we really didn't have time or we really didn't touch on. As you convey and sell assets to the trust, in consideration of sale, and you're selling these at book or basis, so therefore you're not creating a taxable situation. As you're selling these assets to the trust, you're going to be accruing what's called a demand note. It's a fancy way of saying it's an IOU from the trust to you in consideration of sale. 100% of that demand note monies, which could easily be for many of you in the $1 million plus range, any use of those funds for anything, including personal food, fun, or fashion, would not be considered to be taxable. Therefore, you can use it for anything, including your incidentals. So at the end of the day, the monies from that sale, which was the original question, the capital gains generated from that LP that go into the trust, you can use it for anything and everything exempt of personal food, fun, or fashion, though you've got your demand note. And if you did use it for personal food, fun, or fashion, you would also get a K1 for that amount, whether it's 10,000 or 20,000 or whatever that amount is that you're drawing from the trust. But let's take another quick look at it. And I can assure you, and we can talk about this on a one-on-one, your taxable base at that particular time is going to be dramatically lower. So therefore, the impact of that tax, if you're taking a taxable distribution event, is going to be significantly lower. The balance of the tax that was in the trust, because the multi-generational aspect of the trust does not come due, as I said earlier, until the trust distributes. And there is the automatic distribution provision of the trust, which likely means that the trust is going to stay intact for hundreds and hundreds of years. And when it does distribute, anyone and everyone associated with the trust will have passed and have passed by 21 years. Does that help?
Yes, it does. Thank you so much. And also, now do I need a fancy accountant or tax person to file something like this? Is that going to cost a lot of extra money? Because
I'm going to say no and yes, and let me be specific. One of the things that's included with our trust is first year tax return, whether it's for a business trust, if you need a business trust, personal trust return, and your 1041, which is your trust return. So that's already included. Now the question becomes, you may have your cousin Charlie, who's been doing your taxes for years, and who knows, maybe you get some sort of great inside deal or a couple of meals and he's happy, right? If you want, and we have had this situation happen before, I always tell people, have Charlie join the calls with the accounting team and get on with the CPA, so that Charlie at the end of year one knows how to prepare your taxes year two and beyond, should you wish to use Charlie. So the answer is, we're going to take care of it first year. After that, should you want to have us continue to do that or work on your taxes, fine. They're very reasonable rates. On the other hand, if you have somebody that you'd prefer, as long as they know what to do and how to do it, which will require some guidance and training, then they can take over and go from there.
Great. And then do you have like videos training us on everything?
I'm sorry?
Do you have like videos or something to train us on
They
how to
have-
use
Videos,
training videos?
written material. We have a couple of meetings a week that if you can attend, great. And if you can't attend because you've got something else that's pending, the good news is They are, first of all, recorded on Zoom so you can watch it. They're recorded also and rendered into podcasts within 24 hours so you can listen to it. And they're also turned into transcripts so you can read it. And if you've got a question that you wanted to ask or multiple questions that you wanted to ask, but you couldn't attend, again, no problem. Send the questions in. We have a specific email that the questions go to. And at the beginning of the call, all questions are addressed. Then you can come back later after the call, pull up the transcript, put in a couple of key words that were relative to your question or questions, and your answers will pop up so that you're going to get a fast, easy delivery of the questions to the answers.
So my understanding, you give lifetime support?
So Jamila, I suggest you watch
Oh,
we'll send that out to you
Replay.
so you can watch it.
okay.
And we're at the top of the hour, but I have one other question
Sure.
because what Jamila brought up. So my understanding is once you have the trust started, the trust will make the investments, not me as a person. The trust will, and then they'll always be at basis. Is that correct?
Peggy, that was a great question. And yes, all your personal business and your business and or businesses business, i.e. if you have a dry cleaning business, a car wash, whatever, that's going to be doing, and that's where your if you will, your assets will be housed and the trust will be doing the business. And that's absolutely correct going forward, because not only do you get the tax advantages, but you also get the most important thing, which is the asset protection. So in the event of suit, you're not going to have them have the ability to lien, levy, or execute a judgment against that business or property.
Thank you very much.
Absolutely.
Now, we are at the top of the hour. Does anybody have one last question before we stop the recording? Okay, well, thank you, Bruce, very much for being on the show. It was most enlightening, and my head still spins around this. I'm really glad you came and gave us some insight about how this works and what the great benefits are. Thank you very much for being here.
Thank you very much, Peggy, for the opportunity. I appreciate it.